If you have over $100,000 of investable capital, I promise you, you're doing it completely wrong. I'm Stephen Brooks, and in this video, I'm going to show you how I generated over $1.7 million over the past 12 months in my portfolio. And at the end, I'm even going to show you how I automated the whole thing. Let's dive in. So, so when I was getting sued by my business partners and pretty busy with that, and the business was all over the place, I wasn't able to trade at the level that I used to. And I was used to like income coming in, not just, oh, the thing goes up and you sell it at some point. And the dividend on these low cost mutual funds are 1%. So that was terrible. So what I said is like, who is making money with relative frequency without just having to decide which way the wind is blowing. So the first name that always comes to mind is Renaissance Technologies. If you know anything about them, they're the best performing hedge fund ever. They have an annual return of 66% going back 25 years. They're pretty good. And in orange here, you kind of see their results. Now, one of the things that stands out to me is that they have a couple outlier years. 1990 right here, 1994, 2000, and then 2008 and 2009. So Peyton, you see that? You agree with me?
Yeah, I see the pattern here. Yeah.
And then if you kind of like visually black out those years, it kind of looks like they're getting like similar results each year, right?
hmm
Now they're private funds, so we don't know for sure what they're doing, but you're a smart guy. I think we might be able to figure this out.
hmm
And then I landed on a company called Citadel Securities. That's Ken Griffin's company out of Chicago. Now, they are a market maker. We're able to know this for a fact. And how familiar are you with the process of market making?
Very little.
So you want to buy Apple, they will sell Apple to you at whatever price and whatever size you want to buy it at, and then they will hedge that off. So via selling it to you and hedging it off, they are net zero. But they have two mathematical and quantifiable edges. The first is for doing that, they get paid a rebate from the exchange, maybe like half a penny. So you do that a couple million times a day, you're golden. The other
hmm
edge that they have is that the majority of the orders that they are filling are done by retail or retail investors or traders who are typically wrong a little bit more than they're right. So you have
Yep.
those two edges. They just try to do that as much as humanly possible. And then if you look at, they're the yellow portion on this bar chart, Citadel Securities. But if you look at the red portion of this bar chart, that's Virtu Financial. Now we can know everything about these folks because they're a publicly traded company. In fact, in the 5 years leading up to their IPO, they only had one losing day.
Hmm.
Now they're market making. Again, they either get half a penny rebate, do it a lot, or they're filling orders where they are going to be right a little bit more than they are wrong. And then
Yep.
they're not caring about which way the wind is blowing. They're not using any indicators. They're not trying to time it. In fact, Citadel Securities pays Robinhood to be their market maker so they could fill more orders. Now, what I think
Mm.
is really fascinating is they think edge plus volume, not which way the wind is blowing, not which stock is going to perform the best, not which moving average. It's edge plus volume. But what I find interesting looking at the results of Citadel Securities and Virtu, they're kind of getting similar results each year, right?
hmm
Now, if we take that back to our friends over here, Renaissance Technologies, remember we have those outliers 1994, 2000, 2008, 2009. What happened in those years?
Things tanked.
Big bear markets. Now, what is a
Yeah.
feature of a bear market? A lot
You
more
can.
volume, which is a
Yep.
nice way of saying in those years, they kind of just had more orders to fill.
hmm
Interesting. Now, they are big billion-dollar businesses. They pay the most expensive quants and the best machinery to get inside of that bid and offer so they could fill more of your orders. So this is not something that we can do. But then I saw this video right here. It's on the Tasty Trade YouTube channel. It's from a guy who is a former Uber driver turned hedge zero DTE hedge fund manager. And you can watch it whenever you want. But a lot of what this person talks about, way over my head. But the thing that really stands out the most about what this person said is he's doing a trade every 2 minutes when the market is open. That's 195 times a day. Now, on one hand, even though he's retail, maybe he has some algorithm that scans every tradable stock in the market and like every 2 minutes, the trigger or the moving average or whatever he does to decide to get into a trade happens. But what would make more sense is on market open, there'd be like 50. And then maybe a couple minutes later, there would be like two. What doesn't make sense is that that would happen at a fixed interval, 9:30, 9:32, 9:34, 9:36, 9:38. Now, what this person does, I know exactly what this person does. He just does a more aggressive version than what we do, but he sells options. So he
Mm-hmm.
has an edge because whenever you're selling options, you're selling insurance, and there's always a markup for that service. So he too is not caring about which way the wind is blowing, about timing things correctly, about doing it at the best time. He has his edge selling insurance, and then he does it 195 times a day. Now, when I put that model to the test, things started to get really, really good for me. Over $1.68 million over the past 12 months, just by instead of focusing on which way the wind is blowing, by having an edge, selling options, and then doing a lot of it. And the best way I could, here is our particular model on the left-hand side of the screen, doing the strategy one time a day. It's pretty good, right?
Mm-hmm.
But on the right-hand side of the screen, it's doing the exact same thing 5 times a day. Now, what do you notice about the result?
Steeper incline, more consistent, and higher numbers.
You nailed it. More consistent, because it turns out when you have edge plus volume, when you have edge plus volume, and when you have edge plus volume, the variance of the result drops dramatically. And this is why when I was in Boca with my family 2 weeks ago, I didn't even bring my laptop and I wasn't even looking at this, is because I
Mm-hmm.
know the more hands I deal, the better my odds are of winning.